All right, we're live. What's up?
Yeah, same old, same old. No major S&P 500 stocks roaring. Kind of a boring week in the stock market.
You got a fancy shirt on. I like it.
I'm gonna do one of these because it's bootleg.
Oh, it's the bootleg 10 p.m. edition. Buttons are coming down.
Another one? No, just kidding. No one wants to see that.
I mean, I don't know.
You having a good week?
Yeah, it's okay. Yeah, I mean, dude, I'm surprised how it's already bootleg day already. Like, where did the last 7 days go? Yeah, good week.
Yeah, things have flown by for me. Here in the States, we're celebrating 4th of July, Independence Day. So that'll be tomorrow and extra day off. So, Matt, I'll show you it in person, Matt. All right. You got to buy me dinner first. Romance me a little bit,
Matt, come join us, Matt.
Yeah, if you'd like to, we'd love to have you, man. We're going to be talking a lot of Tesla tonight. A little bit. I do want to make one mention as far as Rivian. Rivian did post delivery numbers. Those were a beat. As one of you guys, and I can't remember who, mentioned this when we were talking about Volkswagen coming in their partnership with Rivian, and that they got a full look at pretty much everything at that point. So ended up that. One of you assumed is like, hey, Volkswagen probably wouldn't be looking as serious at Rivian, at least what they were offering, if things were really, really bad on that front. And I mean, they're not impressive, amazing numbers, but what's good for it's good if Rivian survives and other EV players survive as well. It's good for Tesla. I don't own Rivian, not invest in Rivian. I was kind of interested in it if it got low enough, just as a buyout opportunity. But yeah, there we are. And Tevis has disappeared. He's busy buying more Tesla. So,
sorry, I'm back. Yeah, Rivian. I just disappeared for the Rivian conversation. Now I'm back.
Yeah, you're such a Tesla shareholder that you're like, oh, Rivian. You know what? Forget that.
Yeah, I don't. that profile picture kills me every time.
I mean, that's greatness.
Hold on, I gotta tweet this video out. So, Matt, are you coming on? I haven't talked to Matt in a while. I want to chat with him.
You know what you need to do is you need to fly down to Houston and schmooze with us. So,
I would not be against that. Yeah, if I can fly down to Houston, we can do like a live show. That could be fun.
All right. Tweet at Matt. Yeah, it's this time of year. It's not the time you really want to be in Houston, I'll tell you. But I mean, Matt's here, so it's a pretty good town. So,
Bootleg Wkly live now. Here's the link, and I'll put a little Tesla thing on there. Sorry, you guys are like watching me do this in real time. And then Matt, are you gonna jump on the StreamYard? I'll just throw it in the comments there. And then feel free to jump on.
And let me go ahead and throw that up there, Tevis. So this is the main topic.
Yeah, that is the main topic. It is.
And we've been talking about this probably in Bootleg Wkly, like every 3 weeks or so, that we just do one where it's basically just focused on Tesla. There's a few reasons for that, but just to simplify it, it's because we like to make money. And you may not think that. Some of you might not think that because we are SoFi investors. But I think so. Well, I guess first, this is what the stock market does. Is Tesla just immensely better and worth more than it was, back here at 147, 142? No, but there was a lot of fear and uncertainty in the stock, and it's pricing in. Now there's a lot of hope and a lot of people chasing. And we predicted that when Elon Musk was confirmed that Tesla would test and break 200. Were we right, Tevis, or were we right?
I mean, look at that chart where you have it and look at the year to date. I'm pretty sure that's negative. And then if you go to the 1 year, it's still negative, down 12% over the past 12 months. So, and then, and then look at the 5 year. So, I think everybody is losing their shit over Tesla breaking this downtrend, myself included, because it's
5 years. 5-year downtrend. It's not like a little tiny downtrend or whatever. I guess it's not 5 years. It's 3 years. 3 years.
yeah, it's like a 3-year downtrend. But the point being is we're not even like we're just skimming the surface right now in terms of where we can be. And what's up, Matt?
Gentlemen, how are we doing?
Good. How
Please,
are you?
please continue. I don't have much to contribute to the Tesla conversation.
Wait. Are you a Tesla shareholder at all, Matt?
No, I'm broke.
Oh.
Yeah.
Okay.
You chose Rocket Labs instead.
I chose Rocket Lab. My day will come.
Yeah. Tesla to zero or not?
Nah, I just I'm happy for those that hold it. I'm not. Hopefully the streak continues, because I know it's still down from 22. But yeah, I don't hate anybody that holds it. I think it's just I'm waiting for the other avenue streams, like the robots and the energy to truly kick in before I take any sort of long-term position in it.
And that's definitely something I want to touch on is the energy, because so they posted deliveries were a beat over expectations. They are still down relative to where they were last year, so it's not like this company is deserving necessarily of breaking that 407 or whatever the all-time high is after the stock split. But this is the way that the stock market works: is things can get way oversold, sentiment can be very, very sour, and then it can do the opposite. And especially with Tesla, where it's a retail heavy stock, and it's never, well, I can't say never, but at least for not a long time has Tesla ever been based on the fundamentals. It's just not. It's more strongly based on the narrative than pretty much anything out there, and the narrative is just cooking along. So I want to ask Tevis, what have you been doing with Tesla as far as a stock?
Yeah, so I bought more, which is interesting because I was buying in the 160 range. I bought fairly heavily, and yeah, I think within like $10 or $15 of the bottom over the past 12 months. And then prior to that, I was buying under the $200 range when it fell. I haven't bought Tesla over $200 in quite a while, probably over 12 months or so. And I just felt really compelled with the delivery numbers, with the energy deployments, and just the momentum in general breaking that downtrend, that I was like, okay, well, I want to be buying this right now. Maybe a part of it was FOMO, but at the same time, I have a really long time horizon for Tesla. And I just think that, to your point, Roy, like it is driven in large part by that momentum. It's one of those stocks that, will do nothing until you're like, this stock is dead. And then it'll just like 4X overnight. It's done that before multiple times. And, I think that they have a lot of tailwinds. I made a video that I posted this morning about just the justification behind my purchase. And a lot of it was around the tailwinds that they have coming up with regards to the 8/8 event, the energy deployments, and the fact that they have a new facility going live in Shanghai that's going to be contributing in the first half of 2025. The robot announcements that we're probably going to get another robotics day towards the end of the year. We're going to get another a Model 2 along with that Robo-taxi announcement. So there's a lot of stuff to really love. And I mean, we mentioned it on this pod in the past, in previous episodes leading up to the vote, where we were saying that Elon's back in this like wartime CEO mode. He tweeted twice yesterday, and both tweets were with regards to the share price. And he basically said that, people were commenting saying, oh, it's up 40% in a month. It's up 25% in a week. And he was like, this is absolutely nothing compared to autonomy and the robotic side of the business. Shorts are going to get obliterated. And that's really nice to see, man. It's refreshing to see, because for like a year and a half, 2 years, 3 years, this guy was tweeting almost exclusively about Twitter or some politics rabbit hole or getting into beef with someone about something stupid. And now he's like tweeting more and more about Tesla and foreshadowing things to come. So he seems dialed in. He seems focused on that mission, and all of those things line up perfectly. Where I was like, you know what? It doesn't really make a huge difference if I buy at 200 or at 230 or at 180, because if this thing goes up, like I think it's going to go up over the next, 3 to 5 years, then really it's not that big of a deal anyways. And then the other thing that I want to say, just last thing, somebody commented on my post. They were like, why would you buy so high, this and that? And I'm like, okay, well, first of all, that's relative. And second of all, Tesla is literally a third of my entire, like, everything. And if I'm buying, 10 more shares here or 15 more shares there, like, that's not really going to do too much to my cost basis. It's pretty built out. It might move it a couple of bucks up or down, like it's not really going to be a huge deal in the grand scheme of things.
Yeah, and I'm a little bit ticked because I've been buying Tesla. I've quadrupled my position since the beginning of the year, and I didn't hit the bottom perfectly, but I mean everything that I bought was significantly lower than what we're at right now. It's been my number one allocation so far this year, and I'm waiting for rollover funds, which is taking freaking forever. To finish off my Tesla position. So I still have a little bit more buying to do. I will buy. It's like I have a share count figure that I want to hit, and I'm not able to do that, with what I have coming in each week. So I'm just like, hey, I'll just wait to finish it off. But it's like 240, 250, 260. It's like I'll hit that share count goal. Yes, it'll raise my average. That's okay. This is one of those where I plan to hold for a while. Now, Matt, I want to go to you in just a second. Can you throw this up, Tevis? This was 2 quarters ago. Tesla started reporting quarterly delivery numbers. And they've always done that with vehicles, but as far as energy. And so you look here, like last quarter, they reported it for the first time alongside the deliveries. And it was a record. And so myself, as an investor, I was like, hey, more information is always good as far as this, but maybe they're reporting that just to kind of offset some of the horrible car delivery weakness that they had in quarter one. It was a terrible quarter. No one can say otherwise as far as the numbers. And so I was like, well, maybe that's it. And we might see a somewhat of an increase in quarter two. That's this bar over here. Matt, when you see something like this, what do you think is looking from the outside? You're not a Tesla shareholder, but you know some Tesla. Do you think this is one-time thing, an aberration, or at what point does it become real for you? Because you said you were interested in Tesla, but you want to see some of these other vectors, energy, robotics, I'm sure software, AI, begin to play out. So how much of the needle does this swing for you?
So let me take a step back. So I work in the energy industry, and that part of that deals with renewables as well, like solar, wind, etc. 9.4 megawatt hour, or sorry, 9,400 megawatt hours is 9.4 gigawatt hours. That's not a lot of energy. So just point blank, right? What I think is the differentiator between what Tesla is doing compared to, say, like a NextEra Energy and stuff of the like, is that this is energy storage. So if you were to say 9,400 megawatt hours for energy storage compared to 9,400 megawatt hours for, say, normal energy production, you will get a premium for energy storage. So I don't want to discount that. But I am getting a little frustrated, and I'm trying to still understand a little bit. And I've had this conversation, I don't want to say all the time, but several times over the past year, about how, everyone's so impressed by these numbers, but they're not comparing them to anything. And so when you're not comparing to anything else, it looks like a big number. Well, let me give you an example. So that's 9.4 gigawatt hours to put it into perspective. That basically means if you were to have basically summed up all the production for the entirety of the quarter, that's how much they put out. To put it in an example, NextEra Energy has 28 gigawatts of capacity at any given hour, right? So they produced as much in a quarter as 1/3 the entire quarter of what NextEra Energy can put out in 1 hour, right? So 28 gigawatts is their capacity. Multiply that by 24 hours a day, you're getting to like 500 gigawatt hours. Multiply that by 900. You see what I'm saying? Like that's where. And so if you think about it in that perspective, Tesla has not really made a move. The thing that I'm curious about is a lot of this going to individual people like myself, yourself, Tevis, yourself, Roy? Because if that's the case, if you're able to sell, say, energy storage to individual people, you're going to be able to sell that at a large premium. But if you're selling it to, say, some commercial building, you're selling, let's just say, 9,400 megawatt hours, and the majority of that is, say, Microsoft, you're not going to get nearly as much as if you were to sell that to 9,000 individuals or 10,000 individuals. So I guess my question is I still don't fully understand, and nobody can really break it down for me. And I've said this multiple times in terms of a competitor, in terms of who else, because NextEra is also doing energy storage. A lot of Ørsted's doing energy storage. A lot of the super major oil and gas companies are getting into energy storage as well. Compare against those folks. And I think the reason why they don't is because people would realize that it's really not that big a move. I think where it is beneficial is actually the numbers that are coming out. The revenues that are actually coming out from energy are actually pretty good. And like I said, I think that that's due to the premiums that you're able to get off of the fact that it's energy storage and not normal electricity. Mm-hmm. But the thing that I also like to understand is like where I think Tesla would be best is if they were to install this for cities, if they were to install this for other companies, if they were to install this. But what I don't know is if they're just selling the mega packs to whomever and letting them do whatever they want with them, or if they're installing them in select cities. If they're installing them in select cities, I think that's a very brilliant idea. I think that'll generate a lot of capital, because a lot of what we have problems with in the renewable industries going forward is when you have a lot of excess solar going on during the day. At nighttime, you're not producing any solar because obviously you're only producing solar for about 12 to 13 hours a day. Same thing with wind, right? You might have high wind capacity at certain hours of the day, more towards the morning and towards the evening, but you might not necessarily have it during the middle of the day. So if you're able to kind of stabilize that electric load using these mega packs, actually be very beneficial and will help out the grid. So I just want a little bit more granularity as to who these people are that are buying it, what it's being used for, because that would make it a little bit easier for somebody like myself who thinks about it from a end user perspective, what people are getting to be able to cook and clean and power their homes, whether or heat their homes. That's the way I think about it, but I don't necessarily know too much about it. But going back to what you stated, do I think that the 9,400 megawatt hours is an anomaly? I don't think it is. I mean, you just noted that they're going to open up another plant in Shanghai. I don't know if that was specifically for the mega packs or if that was for actually building cars. But
on that one, I don't know. I feel like so this number, that as far as the acceleration, a lot of that is being generated by these large products, large projects rather. So it's the mega pack more so than the Powerwall. We don't know as far as the actual breakdown. Like we may not know at all. Hopefully they go into that, and I think they need to in earnings to say why this is accelerating first, and then second, if it is mostly large projects like I think it is, that tends to be a little bit more lumpy than just selling to consumers. So in a little bit lower margins, you're right. But you're right. There's massive tailwinds that are happening as far as energy storage. So it can get a premium. And can you throw this up, Tevis?
Yeah. Come on.
So this is on what Matt was saying, an energy expert that works for UDoc here. So This is for 54 straight days. This is at the end of May, by the way. So I just found this on the fly. I've seen other charts as well. And 78 of 84 wind, water, and solar, that's renewable sources, have exceeded 100% of the demand during part of each day. And so basically what that means is, hey, it's great. Renewables are working for California's grid, but you can't use more than 100%. Like, you can't. And so energy storage needs to come in to be able to offset this. This continues, and I'll blow this up a little bit. This continues to increase. What's interesting, even in spite of very high interest rates, and so there's less consumers that are installing it right now, but it continues to increase, and I don't see it going backwards. And so energy storage is a massive, massive need. That's why, and Matt's exactly right. There's a lot of competition, and Tesla's not the only one that's doing this. But if they can really nail the consumer side of it, like they can just print money. And let me show one other thing, and then I'll. I know you were going to say something, Tevis, but I thought this was interesting. So this is a Morgan Stanley research report in response to the delivery numbers. Called it the first positive surprise of the year. Deliveries, yeah, we already kind of talked about that. What's interesting is they actually put a value on their mind as far as the energy. They said that their energy they value at $36 per Tesla share, $130 billion, and it's uniquely positioned to benefit from the investment in the U.S. electrical grid accelerated by the AI boom. So maybe not. But the nice thing is, for me as an investor, we know, and Tevis, you agree with this, and I think, Matt, you correct me if I'm wrong, but you'd agree at least somewhat that Tesla is more than just a car company. It's largely a car company right now, but they have a lot of vectors that they're spinning off. But the market doesn't really believe that until they actually have real revenue. They have that now with energy. It's accelerating. Don't know if that acceleration will continue, but if in the earnings report that they say, yes, we expect continued acceleration of this, if this is not just a one-time thing, the market's going to get freaking excited about that.
Yeah. So if I can add just a couple of things here. I hear all your points, Matt. I think the trend is the interesting piece here. NextEra Energy is like 100-year-old company, man. Like it was like 1925, 2024. Like this is all they do. They do wind, water, air, or solar. And Tesla only does solar. So they do solar for residential. They do solar.
When I quoted those numbers, it was specifically for wind and solar.
Okay, so whatever just the solar is, it would be more apples to apples. But I think, so two things. I think number one, Tesla has right now, the trend is really what people are getting excited about. I mean, they're doing about 1.5-ish billion in revenue per quarter off the energy business. So energy generation and storage, that's like what, 6 billion annualized. And that's, I mean, compared to the 20 billion times 4, it would be like 80 billion total. So close to 10%, 8%, whatever. But the California plant has a capacity of 40 gigawatt hours that they're scaling up. The Shanghai plant also has 40 gigawatt hours that they're scaling up. They're just really skimming the surface. And this is just one of the aspects of their business. Whereas, like, I think comparing them to companies that are doing exclusively, their energy companies, essentially, they would need quite a bit of time to catch up. But if this is one of their segments, and it's actually a more profitable segment than the car business itself from a gross margins perspective, it's like 25% gross margins relative to the mid-teens auto gross margins. And so I just think that, like, extrapolate this out a couple of years, and they could be actually, doing a good amount in both the revenue and in the capacity, which would make it a higher percentage of the revenue mix. And I think really it's important to change the narrative as well with regards to Tesla. Like, that's something that makes myself, Roy, we've talked about this before, it makes us very bullish is, Robo-taxi can do that for Tesla. The Optimus bot can do that for Tesla. The full self-driving and licensing can do that for Tesla. The supercharger network that they can essentially license out can do that for Tesla. the idea is that you get this different paradigm from this very one-dimensional, like production equals input, revenue equals output, scale linearly, and that's really the business model. Like there's no X factor, there's no compounder in there. These different avenues, these moonshot projects, I think is their home run potential when you compound them over time and when you aggregate them all together to find the complementary benefits that each like stream has. And so energy deployments, while it's not anything to cry home about when you're comparing them to NextEra Energy and all of these pure energy plays, when you're thinking of them just as a portion of the revenue mix and something that's growing so drastically and that they have the capacity to ramp up drastically, that makes it a really interesting value prop, because all of a sudden you're forced, if you're an analyst, to look at this company in a more comprehensive lens than just a car company.
Yeah, I think I don't want to burst your bubble, but that 28 gigawatts that I quoted for NextEra Energy is also comparable to what you're saying, right? It's one portion of NextEra's revenue, right? They still have Florida Light and Power. They still have natural gas assets as well. So, that's a growing segment of about 1/3 of their revenue stream. So, I'm not trying to burst anyone's bubble. I'm just trying to let people know, that pushback that you're giving is warranted. I get what you're saying, but it's not saying like, oh, you're comparing all of NextEra. I'm not, right? So I just want people to recognize that. But and I'm not saying that what Tesla is doing is not good. I think that they've absolutely destroyed in a positive way how the auto industry works, and I think that they're doing comparable things in a lot of other avenues as well. I think the thing that I just don't understand, and it's probably a lack of education, but I keep asking Tesla investors like yourself to explain it to me as to why it's better than something like an NextEra Energy. Why are these mega packs so great? Why are they so grand? And I understand what you guys are saying. You're seeing triple digit, percentage growth, and that's phenomenal. And I'm not trying to shit on that by any means. But I think what I'm trying to understand is this them counting the solar roofs that they're putting on the houses? Is this counting the mega packs that they're putting out there, the power walls and everything the like? Because to me, when you think about the solar panels, that's going to power people's homes. After you set that up, you're no longer getting a revenue stream from Tesla to Tesla, right? You're getting the installation piece, right, of getting those solar panels built and put onto homes. And that's great. That's grand. I'm not saying that that's bad. I'm just saying when you're talking about apples to apples comparison for, like, say, a NextEra, NextEra is generating and building out, solar panel grids that are then being used by the masses, and they can count on that revenue time after time. So I guess I'm kind of just curious, how these things are kind of done and how they're actually paid back to the organization, right? And it could be a matter of it's through mega packs, it's through installing these solar roofs, installing the solar panels, and that's okay. I just think for me, in the long run, people are going to realize that installing solar panels and solar roofs is going to be way less efficient in the long run than it is having somebody like a NextEra Energy or somebody else do it for you. And it's just like how a lot of us thought, oh, well, let me just continue to upgrade my external hard drives in my house. Well, now everyone's using the cloud, for $1 extra a month to store hundreds of gigabytes, right? It's the same sort of mentality. It's going to get to the point where we use so much energy that it's inefficient. And I get the piece where some people might say, well, in case of an emergency, I still want to make sure I am able to keep my electricity going for my refrigerator, for my air conditioning, etc. I get that piece. I've also thought about it from that perspective for my own home, because I just had a recent storm that knocked out the power for a few days. I've thought about that as well. But I think in the long run, the majority of people don't live in advantageous areas, yourself included, Tevis, for solar, right? It's easy for me living in Tejas to say, let me use solar, right? It's that's just another piece to it. But I'm just looking at these mega packs, and it's like the mega pack thing, while it's grand, to me at the moment, what I'm looking at is strictly like an entry level mega pack is $5 million. An individual is not buying that, right?
Yeah, I mean, like, so let me just get one thing straight, and then I'll jump to Roy. Like, I'm not saying, oh, I'm going to invest in Tesla solar or I'm going to invest in Nexera. I'm a shareholder in Nexera, right? Like, I am not making it an apples to apples comparison. I'm just saying, directionally speaking, it's positive for the company because it's just another one of the segments that's growing. Like, if they were doing, what do you call it? Like 4 gigawatt hours, and that was yielding 1.5 billion a quarter. Well, all of a sudden now they're doing, close to 10. Thanks for the extra 1.5 billion a quarter. Great. Let's add that to the top line. Company's growing. It contributes to their overall growth rate. That's all I'm saying. Like, in the context of Tesla, it makes the bull case more dynamic, making it harder to label it a car company. In the context of the wider energy companies out there, like, yeah, of course, there's a lot missing. They're microscopic in comparison.
Go ahead and throw this up if you don't mind there, Tevi. So this is me, Kevin's guesstimate, and I think he's probably a little bit high because if these are the mega packs, you're going to have a little bit smaller margins on that. But based on the energy storage for sold for quarter one versus quarter two, he's expecting a 935 million, like if it was the same margin. So maybe it's 900 million, 850 million, something like that. But yeah, to Tevis's point, this is now contributing meaningfully to the bottom line, and it's more proof of concept that. So to take a step back, I'm not bullish on the solar roofs. Like, they're neat looking. I would never go that route personally. Like, solar panels on the roof, like we may move a little bit closer to my new job site. And if we have 2 Teslas, I told my wife, I'm like, hey, we might as well just buy a house that already has solar on the roof, as long as the roof is in good shape and we like the house. Because, like, dude, like, we got 2 vehicles that are there. But as far as like the Powerwall and the mega pack, there's a lot of mega packs. Powerwall seems, for me anyway, from my perspective, I think it's one of the best products out there for the individual consumer that's wanting some energy storage there at home. I know that there's many others, including Enphase, that have products like that. But this is one that I think trades at a premium, very, very high margin. And the thing is, if Tesla was just an energy business, like this is all they did, I wouldn't be investing in it. I'd be like, yeah, it's cool, it's nice. But the thing is, it's a tech conglomerate that every single facet of their business is contributing to the bottom line. And they have a lot of vectors that Tevis mentioned, including ones that people don't even think about, like insurance. If they get insurance right and they continue to scale in each and every state as Teslas continue to spread, like that can be very profitable and meaningful, especially when full self-driving is deployed. And a lot of their products, like the neat thing about Tesla is their products largely stack on each other. So, it's not that rare when somebody buys a Tesla and they're like us, where it's like, our car just got totaled this morning. I did post on X this. We got a call from our insurance company that they said, hey, we're going to total your vehicle. My wife went from me initially liking Tesla, and she's like, yeah, you can get whatever car you want, to wanting to use my Tesla. It's ours, but it's mine. Whenever she can, to wanting to sell our car before it was totaled to buy a Tesla, to now she's just like, I'm not going to buy anything but a Tesla. So it's like, that was a month. And now we've gone to the point where it's like, hey, we're looking at getting solar on our next move, because we're probably going to move anyway, just to be closer and have less of a drive. And switching over to Tesla insurance because we can save some money there that way. And we're going to do a large trip in November where we're driving one of the Teslas. We'll be using the superchargers. And so it's just like all these, we went from not having any Tesla exposure at all as a user to all these different products. And that's the way that it works. Is it's well integrated. They stack on top of each other. And with Elon Musk running, like, not everything is going to be equally a success, but like what they have on the horizon, the full self-driving, the software, the robo-taxis, maybe the Model 2. I mean, they're cooking up a lot. So you're paying a premium for that. It's the Elon Musk premium, and also assuming that they're going to continue to accelerate in these other areas that are not that don't do anything yet as far as revenue.
So let me just respond to this. I don't know if you guys saw this review, the Tesla solar review. I've seen several of these videos online, and I think that's what burst the bubble for me for solar, especially like Matt, mentioned. Toronto, where I live, has just absolute dog shit weather, so I would never earn out the solar roof in like 2 decades. But by God, man, the masculine urge to just move to Texas, get a Cybertruck, get the Starlink, and get a full Tesla solar roof and just go completely off the grid and just wait for the zombies. Like, that alone for me is just peak ecosystem effect. You guys are already halfway there.
Yeah, I mean, and my wife is not. She's okay with the idea of solar as long as she loves the house. And the great thing about Houston is we got a lot of choices, so I think we'll be able to find something. But no, like, for sure, that peace of mind of that, and then just I was telling somebody about this where I work today, because they were asking, they're like, "Oh, so your vehicle's totaled. What are you doing?" I said, "Really, too? Isn't that risky?" And it's like, I mean, we save a ton of money. It's a great vehicle. We never really want to own, like, it feels like going backwards anytime I get into a vehicle that's not Tesla. I know that there's other EVs that are good out there, guys, but I'm not like mega rich where I could just throw a Tesla roof up on my house and buy a new Cybertruck, which I don't really care for the Cybertruck, actually. But yeah, but the big thing is, like, this, again, like, going back to what you said, Matt, Tesla, and I think you'd agree with me, is not a stock that trades based on fundamentals. They have an influence, but it trades on a narrative. And things like what they did with energy feed that narrative to the upside. So there is a lot cooking for it as far as a narrative. Now, is there risk here? Yes, there is. I think Tesla, even at like 140 something, there's some risk there, just because, it's not a fundamental based stock. And, if Elon Musk was not given his package and he left, like, we could have gone below 100, like, easily, very easily could have happened. And there was a chance of it that was being priced in. But yeah, the narrative is now shifted the entire other direction. And we see what happens with Tesla. I know there's a lot of people throwing price targets out there, $300, $400. We're not even going to talk about Cathie Wood, but this is one of those where I'm like, I'm not too worried about the price. I see the direction of the company. Elon Musk is locked in. He will not be forever. He's, all over the place as far as, but I don't think he's going to do another Twitter thing. So very excited to see where this goes. Goes to 300, great. It goes down to 150, and they're still doing well. Great, even better.
Let me show you guys something, and we can all put on our tinfoil hats for a moment. I want Maddie to respond to this one first, all right? So I'm just going to throw this up on screen. So Mars posted this. It's a timeline of events. On June 17th, the Uber CEO Dara sold 1 million shares. On July 1st, Elon followed the Uber founder. The Uber founder was essentially ousted from Uber. He sold all his shares. He doesn't have any conflict. And then on August 8th, of course, as we know, we are moving towards the date when Tesla is unveiling their own Robo-taxi network. They already previewed what that app was going to look like. It looks like a futuristic Uber where you basically order a car and the car arrives in your destination. I just found this particular piece interesting just because I think it fuels people's speculation. I think Elon's the type of person where he's done this stuff in the past, and it's like there's Easter eggs that he's dropped which people have verified. I just found it funny. I don't know if it's, building hype, if there's nothing to be read between the lines there, but I don't know. It was just interesting. What do you guys make of it?
I mean, I don't think anything of it. I think it's circumstantial. I mean, that's all it is right now. How many people does Elon Musk follow?
Let me throw that up for you.
Because if it's, I think, if I remember right, it's just a few people.
650.
That's not many for someone like him. So they're definitely looking at what Uber has done and copying and doing some iterations based on that. Whether they actually loop somebody in, like the Uber founder, we'll have to see. But no, the August 8th event is really interesting. It's probably just because of the momentum in the stock going to be sell the news, but like who freaking knows? It's just Tesla's a stock that's hard to predict, like over days and weeks. But I think that they're going to roll out something pretty exciting. I don't think it's just going to be like, yeah, we're going to do robo-taxis in a few years. Plus, Elon Musk is always super optimistic with his timelines. So he's going to say something like, by next year this, and we know it's not going to happen, but it'll happen eventually, just maybe not when he says. By the way, it's unrelated, but I know we have some people that have mentioned, that they're interested in getting a Tesla at some point. If you're in the United States and you're eligible for the use tax credit, so make sure eligibility, you have to make such and such income. We're actually eligible this time because of some things that happened. And my wife hasn't worked this last year. And this next year, I'm like, we're not going to be eligible. And I don't know that there's going to be a tax credit under Trump. But private sellers, so there's a couple things happening. And we'll go back to the stock in just a minute. Hertz has been dumping a lot of their used Teslas, Model 3. That, in turn, just because supply and demand has depressed the price of used Teslas. Private sellers that are trying to sell their vehicle usually get less than some dealership or company or whatever. But the problem is you cannot use the used tax credit with private sellers. It has to be a dealer. Except there's actual services. And I think that we're going to be using one here for our purchase that you go through. And legally, the way it works is this, they purchase the vehicle from the other person and then they turn right around and sell it to you. How much does it cost? It depends on the service you use. The one that we're using is $99 for me and $99 for the seller. That's it. They handle pretty much everything else. It's seamless. It's legal, and you get that EV tax credit up front. So if any of you guys are looking for a used Tesla and you're qualified, but it's a private seller, just keep that in mind. We're getting as long as my wife is like A-okay, and I think she is, we're getting a 2021 Tesla Model 3 that has like 40,000 miles, single user, no rental, no accidents, nothing like that. Carfax is all clean. Battery's in great health for $18,000 plus taxes and fees.
Are we completely going to skip the fact that Roy fully retired his wife on Palantir and Robinhood stock? We're fully skipping that? He's like, oh yeah, my wife doesn't work, so here's all this car information. I'm like, wait, what a minute? Palantir? Robinhood?
We're doing all right. Yeah, Palantir. I'm just selling covered calls. By the way, Matt, I bought Palantir for the first time in a year back in Q2 when it was like 2062 or something like that. It's I don't know what it is right now with Tesla and everything. It's been a crazy busy week, but somewhere like 65-70% of my portfolio, and I'm like, you know what, this price is stupid. So
you probably have more Palantir than I do at this point, for sure.
No, sir. No.
What?
Mega Matt money.
Dude, that's a lie. I know you got more than I do, for sure.
No,
especially if it's 60 to 70% of your portfolio.
I don't know. We might be close though. So
I don't have as many shares as people think. I try. It's less than. Let me do some math because I just set a new all-time high.
Hey, congrats!
Thank you.
Me too. Yeah. Palantir shareholders unite and Tesla.
Yeah, it's less than 10% for sure.
Yeah.
Of my portfolio. So, Yeah, compared to your what 60 you said?
I think it's 65 probably would
That's
be my
awesome.
guess with what Tesla did. So, working to decrease that all the time by allocating to other things, but I'm just going to hold the Palantir. So yeah, we're not retired. My wife, she's actually looking for something part time because she needs something to do a little bit more. But,
Teach her how to write the covered calls.
dude, I have
Because that's generating me about a couple $100, if not $1,000 a week.
man. So let me ask you this, Matt. Like, so since you're here and you've been doing this a while, and we've talked
Yeah.
about this, and I know we do this on Palantir, and I'm sure you do it on some of your other stuff too. Do you track your covered calls, or just kind of?
I don't track specifically what's covered, what's sold puts. I know I haven't tracked. I'll just give the number. I tracked it through May, and I was up about 35,000 just through May, and majority of that was covered calls and sold puts. I'm not sharing my screen right now. Okay, good. I don't want people to see my fake numbers that I keep in a spreadsheet just to try to impress people here. But June, I made about 8,000 in options income as well, and that I don't think I bought anything. Like I didn't do any leaps or long calls. That's mostly just covered calls. So overall for the year, including January, I was down $6,000 in there. So 43 grand in options income for the year.
It's all right. You can, it's just so far. So yeah, you could live off of that if you had to. For anybody that's like watching that doesn't know anything about that, we're not going to teach you how to do that here. TJ the Will Dill, he will. He's somebody that's worth following.
TJ's a good guy.
And that's what he does. Like, he does some other things too, but that's what he does on YouTube. There's lots of good resources out there. Paper trade it, study the Greeks, figure out how it works. It was over a year before I felt really comfortable. And there's things that I learn all the time. But yeah, I've been starting to keep track of it, Matt, for a couple of reasons. But the main thing is just I wanted to really see, I had a feel of how I was doing, but the premiums are, especially when the stock market's very volatile, very, very good. There's always a risk. So I know that there's probably someone out there that's watching and has covered calls on Tesla. Those are probably gone. That's the risk, but you have to be good with whatever you're selling as far as a strike, or be willing to roll it out. For myself, somebody asked if I'm doing Palantir covered calls, and yeah, all the time, like every week. I usually do weeklies or every other week, depending on what's happening. And there are times when I'm like, the premiums are just not there. It's not the risk reward's not there, but usually, yeah, I'm selling those. And the reason, and I only do this, by the way, and I think, Matt, you would be the same. There's people out there that'll just do it because the premiums are juicy in a stock that they don't believe in. That is a great way to get burned and have regrets, because you'll do well for a while, and then something will happen that you don't fully understand, and you're just stuck with a big loss. I'm doing it when I sell cash secured puts. If I do, and I do less of that, I do more covered calls. It's only stocks that I'm comfortable owning at that price. So I either get the premium or I get the premium and the stock. Covered calls, I'm selling at strikes that I'm comfortable either selling or rolling out. And I have a very, very good understanding of what's happening in that company. There's always surprises, but I don't know. I've had to roll, I think, one time for Palantir in a couple years, just one time. That was a painful rollout, but I mean, that's the price that we pay. So
yeah, most of the time, sometimes I get greedy because I do have a margin account just in case. I don't really like to trade on margin, but just in case I end up, wanting to write something that's a little risky. Sometimes if there's a day or two left, and let's just say it's super out of the money, I'll write for the next week or something like that, and still let my other ones kind of expire. Because otherwise, if you were playing it by the book, you'd have to wait until the next Monday before you could write again, right? So. So sometimes I get a little bit risky like that, but I would say in terms of having to roll these past 2 or 3 weeks, or maybe it's just only the last 2 weeks, I've had to roll. Most of the time I end up just rolling just because I want to close out the old ones and write new ones, right? It's not because I need to. It's because, we're getting close to the end, and I just want to make sure that I don't have two sets of options kind of running, right? I want to make sure that they're actually covered and one's not covered and one is covered. So, but yeah, normally I play pretty safe and do really well with it. I have some on SoFi right now. SoFi is dog crap because obviously it's single digits, right? And so $1 is like 10% movement. So it's hard to write covered calls on SoFi right now. But I think I have the $10 August calls that I got for like 8 cents. So that's as good as I could get. So we have that. But I write it on Xterra. I write it on Dutch Bros, Google, Amazon. And you have to think like my top 4 or 5 positions is like $450,000. So when you start writing just simple, small covered calls, for example, this Amazon call, it was super far out of the money. It was like a month out. It was like $950. So if you think about it, you just let that go to expiry or close to it, and you time it right. That's $900 a month. I end up rolling some of them, so they might have $100 or $200 still of meat left on the bone. But because a lot of times I like to just keep the ball up in the air. But yeah, sometimes you can make a pretty penny if you keep track of it right.
Yeah, it's actually a good chunk. Like I'm contributing as well. I'm putting money in, but it represents a good chunk of what I'm reallocating to the market just at this point. Like
that's awesome.
I had not checked my spreadsheet, but I just remembered like when you checked yours, Matt, I hit a nice milestone off that Tesla pump.
Yeah,
I'm pretty happy about it.
I'm trying to think. I'm trying to remember where you were back in February when we met up.
I think Roy knows. But
you have to message me.
Yeah,
I'm telling you, man, you're gonna be when me and BD Tevis were chilling, drinking mojitos and God knows what. I was like, dude, you're a couple years younger than me. You're gonna surpass me, by the time you're 33, my age.
Oh yeah. Bro, I'm gonna be 30 in a couple days. It's fucked.
Yeah, you're like I'm telling you, man, that's big boy money. That's big boy money. Yeah, you got to double your goals you'll be on track with me if you double that number in the next 2 years. So by the time you're 31, because I
think do that.
Yeah, you can do that. Exactly.
You can do that. It's gonna be fun. The market has to keep it up. But Matt, I've really been loving the dividend portfolio. I've been loving it because it's like half the fucking things I bought in the dividend portfolio are up like 40%. It's ridiculous. But it's fun, man. I collected like $800 or $900, something like that, over the last quarter. And like, I want to be breaking into the 4 digits next quarter. I'm still I think what I'm doing is, so I want to save up to probably make a big purchase, like a property or so within the next, 12 to 18 months, however quickly I can save that money. And what I'm probably going to do is all the money that I save, I'm just going to put in like SPY or QQQ or something, just to use as a piggy bank, as opposed to like splitting that out across the positions that I have. And so yeah, I'm going to be building a massive QQQ position over the next 6 months.
I would look at now, of course, do your own due diligence, right? And I'm playing across international lines here, so give me some rope. I think RRSPs have very favorable loan rates or something like that. So if you were to like dump a bunch of money into it and then take the loan out, you're pretty much going to get your down payment money for a pretty substantial discount.
They cap how much you can loan out. It was like $30K, which doesn't really fucking make a dent.
Yeah, it doesn't make a dent. Yeah.
I think they moved it up to maybe 50 or so. Still doesn't really make a dent. Yeah. But yeah, that's how they can control that. Because if I could pull like, 100, 200, whatever out of the RSP, then that's great. I can just like repay that back eventually. But yeah, I thought about that, but they cap it.
Okay.
They don't want you to win up here, man. They don't want you to win up here. It's life on hard mode.
There you go. Yeah, they only let me take out 2 loans at a time for a total of 50,000. So I just do it for a little bit, right? Because I'm like, normally I have a lot of cash on hand. So, for example, when I bought the first Airbnb in December 2022, I had the majority of that cash, but I think I still just wanted like 10 grand or whatever. So I pulled that 10 grand instead of selling something and taking the cash out. I just loaned it for my 401k, and then it just takes it from my normal paycheck. So it's not like I'm paying a bank, I'm paying myself, which isn't the best way anyway, right? But I didn't want to sell any stocks, which I'm happy I didn't, because 2023 was a fucking phenomenal year, right? So
yeah.
And then I just did that recently as well with the house we bought in May, which I was surprised, actually. We've rented out 10 out of the 11 weeks of summer so far, and all the weekends of September, plus a full week in September and a couple weekends in October so far. So I'm like,
Is this the newest one?
this is the newest one. I was pretty scared. We undersold the shit out of it. Like, we left probably like 5 or 6 grand on the table in terms of like income. But the fact is like, we just wanted to make sure by the time we get to September, October timeframe, we have enough money to get to next year. And that's really the big goal. So yeah, the fact that we're getting some good feedback from folks. We have our second renters in this week. We had our first renters in last week. So yeah, fingers crossed. The other Airbnb, somebody trashed it this past weekend, but we got it cleaned up. So we're good. People checked in today. They're like, it looks beautiful. I'm like, thank fucking God, because the cleaners called me freaking out. So anyway, enough about that.
Yeah, I'm definitely not catching you if I double that amount. Like, you have 2 properties?
No. Catch it by the time I was 31.
Oh, okay. But
Yeah. No, I'm closing in on. I'm 3 times that number now, but yeah, I'm closing in on the new.
More than 3 times that number now. You were like 3 times that number back in like Feb, dude.
Yeah, it's been hanging out around there. Yeah, I'm only like 100,000 more than that now.
Rocket Lab's been hurting them. Just kidding.
Yeah, Rocket Lab's been dragging on this damn portfolio.
It's been doing good, right?
No, not as bad as SoFi, you bastard. No, I'm just kidding.
Yeah, you're only down like 13% year to date. So
yeah,
it's
not bad.
That's like a bad day for SoFi.
Yeah. And Tavis gave me crap. He was like, I can't believe you don't want to buy it at $8.10. I'm like,
Are you buying more? Are you buying more? Are you buying more?
Unfortunately, no. I don't have any damn money, and every time I do, I keep buying Rocket Lab.
Yeah, there you go.
You know what you can do is you can sell some covered calls and use that to buy SoFi.
I might actually, and I've thought one of the things. So I don't know if I talked to you. So Tevis,
yeah,
be cautious about the dividends, man, because they turn to a slippery slope. So like, because you can control the number, right? You know how much money you have to invest. You can read the dividend yield percentages, and so you're like, I want to get to $25,000 a year real bad. And so then you'd be like, well, if I just invested 6%, and then it starts to get. So I started traveling down that slope, and I recognized I was underperforming the market really bad. And there was other reasons why I was investing strictly in dividend stocks too. It was mostly because I work in the oil industry, and I joined the oil industry in 2012, 2013 when everything was $100 a barrel, and they were like, for the Christmas party, just please sure you don't order anything that's more than $25 a drink, sir. And I'm like, $25 a drink? Oh. So I'm like,
drink.
What's that Macallan 18-year cost? They're like, that's $21 or $22, sir. I'm like, get me a couple of those. And so I would just drink these. And next thing you know, I'm seeing people get their heads chopped off at work because they're getting laid off in like the next 12 months. And I'm like, Jesus Christ. So very impactful when you're 22, 23 years old, just out of school, thought you were living the fucking dream. And next thing you know, you're seeing people's livelihoods go down the drain. So dividend stocks was like my savior for a while. And then it got to the point where I was making like, I think, I'll have to pull up the numbers right here. Here it is. 2020. 2020, I made $15,500 in dividend income. And then 2021, I made 23,000. And so then I was like, what am I going to do with $23,000 in dividend income? I'm not retiring tomorrow. And so that's when I was just like, I need to start investing in more growth stocks, long-term focus, stop focusing about dividend income today. You're selling yourself short. You're underperforming the market. And even still, by selling off and transitioning the portfolio throughout all of 2022, which was the perfect year to do it, by the way, because everything was pulling back drastically. I still pulled about $26,000 in dividend income in 2022. And that's dividend income. That's not including covered calls and stuff like that. And then last year in 23, even after this whole transition of a portfolio, I still made like $23,000 in dividend income. So my hope is like, I'm going to level off at about 20-ish thousand. And then as I continue to grow the portfolio, it'll slowly climb back up. But it was forecasted like in 2022, I was going to be making like $29,000 or $30,000 in dividend income. And I was like, what am I going to do with that? I'm 31 years old, 32 years old. I'm like, that's stupid. I'm like, I'd rather be focused on getting to $10 million than trying to get to $100,000 in dividend income. I was like, what means more? What would give me more freedom, more power, more influence to be able to do things in the long run? And the answer was obvious. It was get to $10 million. And so I was like, if I'm really going to play the game, let me play this game, right? Instead of selling myself short and trying to get to $100,000 in dividend income so I could retire early. And so it worked out well. 2022 worked out well. 2022 was scary. I was down about $350,000 at its worst point. And I'm shitting a brick because that's pretty much how much this house costs that I'm living in. And I'm like, I'm down a house, and people are like, ha ha ha. And I'm like, no, I'm down a house.
Yeah.
And that's scary for somebody that's 31 years old, right? And then, now we're back up and we're doing rather well. So, yeah, it's some scary shit. But overall, I think I found what works for me, but it goes to show like some people get very into the dividend things, and I get that. It's nice, but at the same time, you have to recognize is like is focusing on dividend income this young that important?
Yeah, I think like for me, it's a little bit different. So here's the secret: the dividend portfolio for me was like an experiment.
Yeah.
And if you were to ask me right now what the dividend yield is, I could not have the wildest guess. I don't look at that shit. I'm like a kid at Christmas when I see dividend money coming to that account. I'm like, you paid me to hold this? This is ridiculous.
It's crazy
Especially
shit.
I don't like sell covered calls or anything like that. And I'm like, you guys get paid for this stuff? This is amazing. But it provides a level of stability, I think, to my portfolio where I can just put it in these stocks that have just a lower volatility than the other stuff that I would otherwise be investing in. Because other than that, it's mostly like 3 names that I'm buying right now.
Yeah.
4 names that I'm buying. And that's like it.
Yeah. You don't own index yet. So,
yeah.
Yeah. And for me, I want to clarify something too. And I should just get in the habit of doing this. More than half of what I have invested is in broad index and ETFs and things like that. That just from when I was, I think, 12 or 13, like that, we started building that up. I was blessed to, be born and raised in Alaska. And so we had that permanent fund dividend check, and like wages were really good in the summer, and you could work, 16, 18 hours a day, plenty of sunlight. So started investing at a young age. My dad, blessed me with some of that, but I didn't know individual stock investing. That's relatively new for me. And so I have that stable base of more than half of that, of being there, so that if I invested everything that I have as far as individual investing and 0 DT options, and it's all gone, it's all at 0. It's Matt Farley's dream of it going to 0. I can still retire.
Oh, yes.
And so that allows me to take more risks as far as concentration, and also some riskier names for me personally. Like, it allows me to sleep at night. Like, people are like, how can you do that with 65 or 70% bound years? Like, well, it's really 35%. It's still a lot. But and then the other thing I was going to say is I have no dividend stocks. I think some of the stocks that I'm holding will be dividend yields at some point in the future, and I'll still probably own them. But I think of covered calls kind of the same way, where you can fall in the same trap where you're trying to make X amount from covered calls or X yield, and then that puts you in riskier and riskier positions, and also riskier and riskier names. So just be careful, guys. When you set your goals, to not like force things. You'll get there eventually. If you track things, if you calculate your risk, give yourself time. Like if you have time, give yourself time. Matt, you were going to say something?
Oh yeah. Sorry. No, that was really good. Mine's silly compared to what you just said. Tavis, did I ever convince you to buy Stag, or did you not get Stag in the portfolio?
No. Is that the strip club ETF?
No. That's Rick. No, but I don't have that, but it's a funny one. No, Stag is Single Tenant Acquisition Group. It's a warehouse REIT. They mostly they focus on like big companies that utilize warehouses. So like I think Amazon, Red Solo Cup, companies that need a lot of storage.
I have I have 3 REITs right now, and they're all down in terms of the like from where I bought them in January. Starwood is down 9% for me. Realty is down 6%, and then the other one is Vici, and that's down 10%. But those are going to be fine when the rates come down, so I'm not really worried about them.
Yeah, I know Realty is the Stephen Fiorillo special. I'm afraid of unless they change who their clientele is, I'm pretty scared in the medium term about Realty Income. But I agree with you. I think right now you'll be fine when the rates kind of get cut. They're just struggling with weighted average cost of capital right now.
It was just like a fun exercise when we did it back in January, when we were like, hey, do we pick this name or this name, this name or this name, this name or this name? And just to see where they are now, like Broadcom was like the best pick. It's up 45%, Amex 23%, Apple's up 22%, 3M 20%, NextEra 20%, Exxon's up 15%. RTX, Raytheon up 15. So generally I'm doing pretty good in that. I haven't really put more money in it in a couple of months, but I think all the new money that's going to go in is going to go into like a SPY or a QQQ or something. I was also thinking about SMH, like the semiconductor ETF, just as a play, but I don't know. Probably just stick to QQQ, honestly.
Yeah, the dividend portfolios can get really, really crazy, because if you start thinking about the dividend yield of the portfolio, it sounds like yours is about 3%, just based off our conversations. You think about it, if you reinvest, then next year, just without any dividend raises or anything like that, your dividend yield should grow. Or not yield, but your income should grow by about 3%. And then if you start thinking about, well, most of these guys are going to raise 5 to 6% because they like to outpace inflation, then you start thinking, you're like, well, that means I'm automatically going to get a raise of about 7 or 8%. And that almost gets intoxicating as well, because you start thinking, you're like, well, shit, I have 12 grand in income that's coming in. Let me reinvest that, right? So 12,000 reinvested at 3%, that's going to get you another $360 just from that. And then any dividend raises 5% off of that, you're going to get close to another $1,000 a year just by reinvesting the dividends without any sort of massive extra capital contributions. So that's kind of the beauty of dividend income in that respect. And I can understand why some people get completely infatuated.
So, look, like I'll bring up the sort of topic that I brought up, a couple of bootlegs ago, where, and that I brought up in our text messages, right, with you and Steve. Like, a part of me And Steve was like super against this because he's like, never sell and like just don't do it, don't touch it. And I get that. My thought was, hey, look, Apple's up 22%, Microsoft is up 15%. Why don't I just sell them both and just do QQQ? Because QQQ will also give you a yield. The yield will be fairly in line with what these guys are going to give you, maybe slightly less, but you're going to have a lot more safety across the board. And so like I've been also thinking it from that perspective of saying like, why would I hold 25 individual dividend names when you can? And then it's like then it gets pervasive the other way around, right? Where you're like, why do you hold 25 individual names or you can hold 5 ETFs? Why do you hold 5 ETFs so you can hold 2 ETFs? Why do you hold 2 ETFs? And then you're like, just squirreling money away. Then it just removes the fun of it.
But then is it about fun, Tevis, or is it about making money?
I don't know, man. Like a part of me is like, oh yeah, it shouldn't be about fun. Like just empty that part of your brain and have it for something else that's more pertinent in your day job. And then like I compartmentalize all this shit. So like a part of me gets like really happy that I made $900 a quarter. And then another part of me is like, fuck it. We're going to like go online betting for $900 or what, like just doing the most degen stuff. And I'm like, why am I focusing on dividends when I'm just like blowing it on the other side? But they're like two different parts of what I want to do. I don't know.
No, I know what you're saying because I go down this runway of, and I'm like Roy, majority of my money is in the S&P 500 and it's kind of parked. And that allows me to hyper focus, right? I used to think about what 30 dividend stock companies can I hold. Now it's like, well, the majority of my money is in the S&P and I can hyper focus now on a set group of companies that I think will overperform, not necessarily in any given year, but in say a 3 to 5 year time horizon or 5 to 10 year time horizon, and be okay with if they lag a little bit because I have the majority of my capital continuing to track with the market, and then I can focus. And it just turns out, Palantir was a crap investment for me between 2020 and 2022. Preach. And it really only turned around over the last 18 months. So in Wkly has been a dog shit investment for me. I've been throwing capital at it, but I have a strong feeling we're literally about to have hot fire on the medium launch vehicle engine. And like they were literally just on the last pieces of the tests today. And hopefully within the next week or so, we actually, fire that bad boy up. And that's going to be like a Falcon 9 competitor. So everyone's going to be super fired up about that. But there's capital exposure risk until 2025, maybe 2026, and who knows? I'm okay with sitting around because I have that patience and I know the majority of my money is tied up and the majority of my 401k and everything like that is tied up in say an S&P 500 equivalent. So I'm okay taking a little bit of risk for a certain amount of percentage of my portfolio. And I've gotten to the place where, if you have a couple positions, then, I'd say 3 positions at about $80,000 that I think are somewhat risky. That's probably my limit, but I don't view Palantir as risky anymore. So I've let it grow to above, 80,000. It's close to $120,000 position for me now. And I think that'll continue to do well. It's a profitable company now, right? So I'm very comfortable that it's going to continue to have a mind of its own versus like, if I were to have 10 Rocket Lab positions in my portfolio of like $80,000 to $100,000 a piece, I'd probably be freaking out. But especially in like a 2022 year where everything pulls back 60 to 70%, if you're in like those high risk companies, man, talk about being down a house. I'd probably be down 2 or 3 houses, right? So it's, anyway, just some thoughts.
Yeah, and I have my 2 laggards are obviously PayPal and SoFi, but I've been in investments before where the thesis has changed, and when it does, I cut those. There's no reason, I look for an exit. Like sometimes, usually that's very quickly. It's not necessarily that same day, but like in a week or 2. Like,
and SoFi, you're not looking for an exit.
No. So with SoFi, and I know you're saying that tongue in cheek. I think you probably are anyway. With SoFi,
No, I know you're not. I was just kind of want to hear your thesis
yeah.
because
So the
for me,
stock,
I'm like kind of on the edge where I'm like, I could see it being a company that gets into the $30, $40 range in say, a couple of years time. But at the same time, I'm like, do I have as much conviction in that 17, 18 grand or whatever it is now? Because Tavis hemorrhaged me. And I'm just kidding. It's not a lot of money, but to me, I'm like, I sit there and I'm like, I don't have the conviction in a SoFi like I do in Palantir or a Rocket Lab. So why am I putting and leaving that money there when I could potentially have it in those other two?
Yeah, I've actually. So when something's down, like I do more DD, and it's not to make myself feel better or worse or whatever. It just is like, are there things that I'm missing, and are there things that the market's missing? And sometimes I found the former, and sometimes I found the latter. SoFi, the market is missing it. I mean,
I agree.
It's not the perfect company, but okay. So the bear argument is SoFi is just a bank. So how are banks valued? Tangible book value, price to tangible book value. Simple as that. SoFi has grown their tangible book value immensely this year, immensely. And if you look at their price, I don't, I've been busy like the last couple of weeks, so I don't know where the price to tangible book value is. But when I was looking at this maybe 3 weeks ago, and we were, I think, actually higher in price at that point, the price to tangible book value was lower than Bank of America. It was lower than the median average for banks as far as the price to tangible book value by a decent clip. And we've fallen since then. Are there risky assets that they're holding as far as personal loans? Personal loans do have a risk, but you look at the actual credit score on that. I don't buy that, and people accuse them of like, oh, they're not using the fair value accounting standards or whatever. It's like it's hogwash. But the thing is, there's almost no risk when you get to. I mean, there is risk. There's always risk, whatever. But there's significant less amount of risk than like $8 and $10 a share when it's trading at this level of a price to tangible book value relative to where banks trade. It's like if it's really just a bank, then it's actually undervalued. Plus, it's growing faster than a normal bank. Plus, I think that they're more than a bank too. So they have all these other vectors, and their narrative is tied very, very firmly to the interest rates. And so the company itself, makes its money from three different vectors. It does, some of those do very, very well in high interest rates, and some of those do well in low interest rates. And as things shift, it's never going to be firing on all cylinders at the time, but it gives it some resiliency. And so, but the stock, the way it moves, it acts like this company is 100% reliant on interest rates. Like, does it benefit when rates are cut? Yes. I think rate cuts are coming. I think it's a matter of time. When rate cuts actually happen, so I did this piece on X a while ago, only got seen by like 3,000 people. I think it was late last week, maybe not on a weekend. My fault of releasing it whenever. But I was looking at student loan competitors. A lot of student loan competitors. This was what SoFi used to do only as their own, basically their main revenue source prior to.
Was this on X or Seeking Alpha? Or?
It's on X. And ended up that a lot of the people that offered student loans, either originations or refinancing, they have exited that business. Can fintech players come in if there's lucrative enough reason to in the SoFi space? Yeah, or in the not SoFi space. It is their space. But in student loan refinancing, yes, they absolutely can. I think that what's going to happen at some point is when rate cuts actually happen, if you look at, and I have it in this post as well, the rates have raised actually pretty significantly. Let me just give me just a second. Let me pull this up because I have some charts and graphs and stuff, and we won't go like too deep in the weeds. But the long or the short version is it's at this price. There's not much risk, and I was just thinking, is like, what, I'm good with what I hold right now. I looked at what I actually have as far as allocation. I allocated a lot more than it's worth right now, but I'm like, I have these rollover funds coming in. And I was going to maybe nibble a little bit at SoFi. Is like, no, I'm going to buy more SoFi than I expected. Still more PayPal. And I need to finish off that Tesla position. And I just initiated a position for Nubank. Man, where is this? But yeah, it's the business has intentionally also slowed down their lending. The one thing for me is I don't know when they'll change that. I think that I do, based on some comments that they have, but I've been wrong for sure. But the reason why that their revenue has decelerated as far as the way it's growing is largely their own choices rather than anything else. So maybe the reason why no one saw it is because I never posted it.
Very good. No, I mean, I struggle, man. I'm like, I view the stock as cheap, knowing that it's EBITDA positive now and it'll continue to do extremely well and grow specifically. And I'm trying to think that is it just need full 12 months of EBITDA positive before people really are like, okay, these guys are out of the woods. They're actually making a gap EPS run and they'll actually be gap profitable and
dude, remember when Palantir was $7? And I remember because I bought Palantir at this price. It was $7. This is right before they announced the AIP announcement. What was the commentary around Palantir?
It's exactly the same.
What was the sentiment around?
Zero.
Like, yeah, exactly. And it's just like sentiment follows price. Yeah. And that's like what SoFi is to me right now. It's Palantir at $7. And, you have the conviction on Palantir and by all means sell SoFi and go into Palantir. I did the exact same thing in reverse for the exact same reason. So I can't fault you for that. But the point is that, why buy SoFi? Like, yeah, we can go into this whole rationale and thesis as to why it's undervalued. But the fact is, it's fucking cheap, dude. Like it's cheap. I want to concentrate into it because I know that when it hits $11 or $12, that might be this year. It might be next year. It might be 2026. Like when that happens, it's a when. People are going to be starting to jump on the bandwagon. They're going to drive the price up higher. And they're going to say, why didn't I buy earlier? And those are the same people that are bashing the shit out of it today. And like, that's fine. Like I can take a little bit of criticism today. I'm sure, Roy, we can as well, like on the Wkly podcast talking about this stock. But the fact of the matter is it is like rock bottom cheap. Nobody wants to touch it with a 10-foot pole.
Throw this up, please, Tevis. I found it finally. So these are the rates for new private student loans. That doesn't look that great, does it? But these are the federal rates. They continue to increase. And as far as undergraduate, so they have, subsidized and unsubsidized. Subsidized is just it doesn't accrue interest while you're enrolled in, a certain threshold of classes. I think it's, anyway. And Grad Plus loans, these are the Direct Plus loans. And they also have direct subsidized loans that are higher rated graduate. 9% interest rates. The current loans that people have are actually lower, but SoFi is not doing a lot of this right now just because they've scaled back on their lending. It's not because they're capital constrained. That's not an issue. Like they could issue just a ton of student loans if they wanted to originate or refinance at a certain point. The neat thing is with student loans, unlike personal loans, you cannot just get rid of them through bankruptcy. It doesn't work that way. So this is a pretty large growth vector. And I noted here, it's like, okay, so when rate cuts occur, that's a big tailwind. And I think that we're going to get one this year, pretty much no matter what, because of national debt and also because of the election. If we don't, it's going to happen real quick. I think when rather than if Trump is elected. Like I just don't think Biden has much of a chance now. I noted Trump, if elected, likely won't further student loan forgiveness. SoFi, they can't officially say, hey, we hate student loan forgiveness. But let's be honest, like that was their core business before. Now they're diversified, but whatever. Penalties actually kick back in for student loans in October. There's some penalties, not any real ones. Meaningful ones actually hit in October. The way that students work, and Matt, and you may be listening, and if you're not, it's for everybody else. Students fall in two main camps. And I know some of these are former students, but some will, the moment something opens up and it is available or changes, they will that day take care of business. But most students are, I will wait until the absolute last moment and even a little bit after to actually get things done. And so if rates have fallen and SoFi is opening up their loan book, they can sell a ton of loan originations, and there will be some refinancing as well. But later down the road as well, over the next couple of years, like I don't think that these rates will necessarily be around forever, but some folks will be locked in at that rate. So Republicans also have called for plans. Trump has not said anything on this yet to shift to privatize student loans. And again, competition has moved away. So Discover, they're done. They're out of the student loan business. Figure Lending, another big one. Nope. Cornerstone, Morgan Stanley, KeyBank. KeyBank or Laurel Road is what their asset group that covers it. They just shifted to, I think, like dentistry and like very specialized student lending type stuff. That doesn't mean that's here forever, but yeah. And so SoFi is just going to immensely benefit. Oh, I did get 6,000 views, so not great, but whatever. That is one of many tailwinds that will, it's basically inevitable that it'll come unless people just stop going to college.
Yeah.
So yeah,
I have a question though. Is that it? Are those real rates though? Because I remember when I went to go apply to this house, somebody, I don't know if it was one of you or somebody else, they sent me like this. Oh, SoFi's given like a 6% interest rate, mortgages out. And I was like, once I went to go sign up, they're like, no, you're an idiot. It's still 7% like the rest of us. So I don't know. So I'm just trying to understand, like, is that actually real, or is that like a teaser where you have to have super qualifications to be able to get it and stuff of the like?
You do need to have, good qualifications to get that. And then you also need to have, be a SoFi member. You get a small discount for that. And there's one other small discount that like people can do, quite easily. But yeah, so not everybody will qualify at all. But it's just showing that industry has, I actually kind of think of it this way. It's not exactly the same, but remember when like FTX and not Silvergate, a lot of the other big crypto brokers were just scams and going belly up and everything. And crypto was just in the gutter. And I was looking at Coinbase and I never pulled the trigger, but I was like, man, if crypto ever turns around, and I thought it would inevitably, like there's not many players left. They're almost a monopoly. Not quite. SoFi, it's not quite the same thing. And fintech is fairly agile. So there'd be other players, but this is an area where they do very, very well. So I think that they'll thrive in that different environment. And as far as how many cuts we get and how fast we get, I mean, that's up for debate. I would have thought that we would have had one already. We don't. So time will tell. But no, this is between factors like this is not like the only growth thing. And I think this is maybe one of the least interesting growth aspects. Like the tech platform is really, where it's at. The financial platform is just like cooking on all cylinders. It's doing great. Member growth is really, really good. And at the price to tangible book value that it is relative to other banks, it's even cheap by that metric, even if it just was a bank, which it's not. And even if you ignore its growth, which I'm not doing. So that's my perspective, doing a lot of DD on it. And I'm like, you know what? I went from, and I still think SoFi might be dead money for a year. Like we could trade in this range. We could go down to $5. We're not going to go down to 4 unless there's like World War III or something like that. It just, even at that point, even the most bearish people have price targets on SoFi at that. They'd be like, oh, wow, it's undervalued now. But I also thought the same of Tesla. I'm like, you know what? Tesla could very easily be dead money this entire year. It kind of is hurt a lot by interest rates, but the script has flipped. I thought the same thing with Palantir. You mentioned that when it was $7 a share, my largest purchase was like $6.30 or something like that. Bought a bunch of shares through a cash secured put, a number of cash secured puts that I wrote, and went those filled, and I'm like, I'm good with it. Could be dead money for years, but eventually, like
I was selling puts on SoFi a couple months ago when it originally dipped into like the 6s, and then it jumped back into like the high 7s, and I never kept selling, or I never let them expire. And I think that's something I should have continued, because I do agree. I think down here it just doesn't make sense. It's disproportionately valued to the downside, and I just don't personally see it. And I could be using that income to buy more shares.
But I will say this too: like it's harder to do that with confidence on a stock that you haven't put in as much. You've not been following SoFi for that long. Like you just
No.
And so like I just initiated a new bank, but there are things that I will not do with my shares, and there are cash secured puts and covered calls. I'm still getting a fill of new bank. I've been tracking it for like 6-8 months as far as active interest and doing some due diligence and research, but versus like Palantir, like I've been in freaking forever. I mean, not forever, obviously, but shortly after DPO, like I kind of know what to expect, and so it makes it easy for me.
BTG.
All right.
Shall we call it here, gents? It's been an hour and a half. I think that's been an overall good episode. We talked about a whole bunch of stuff. Matt, really appreciate you joining.
I'd chat forever, but yeah, I do have an early flight to catch, so it would be nice
Thank you, man. When are we all going to take some time off?
I will be back in Europe in late September, so I can do anytime in August, early September, or October.
Okay, Roy, Euro trip in the fall?
I just started a new job, so I can't do a lot right now, but and still working on the PhD. So
there you go.
Maybe in a year, though.
Dr. Roy.
Yeah.
Yeah,
Maybe.
Actually, I'll be in Europe around the time of Oktoberfest, so I might stop over. It's almost been 10 years since I've done Oktoberfest. So,
and we were talking about my wife, learning zero DTE covered call. He's like, her investment strategy is so freaking risk taking. Like she is risk on all the way. Like, I don't know, man. Don't tell her about zero DTE options.
I've printed on selling zero DTE Tesla puts, and I've also hemorrhaged cash doing the same. So ended up having to roll and stuff like that. But I'm upset because 2 weeks ago I actually was thinking about starting to sell Tesla puts, and I just never got around to it. So a couple $100 down the drain.
Yeah. Nothing wrong with a small bet just for fun. So anyway,
I am down for Oktoberfest. Matt, let's talk more about it because I can probably do some trip around that time. Let's do it.
Yeah. But
little Munich in October.
What's that?
Munich in October.
Yeah. So I'll be in that part of Europe end of September for work, and then I was thinking about taking the next week, whether or not I spend all of it in Germany. I've already done Germany before, so I'd like to see some other European countries, but I was also thinking about, do I take that opportunity to kick off and go to Asia for a week or two? So
all right, well, we can chat more about it. Gents, it's been a great episode. Thanks everybody for sticking along to our rambling selves, and we'll see you.
Come here.